What's the operative theory right now for a Fed? Let's say they're restrictive. Some would say they're super restrictive. Underlying that is a need to turn at some point. What's the theory they have right now to get ready to turn out, quarters out, meetings out?
Well, that's a really good question, and I think the answer to that is it's all about the dual mandate. That for a long, long time they've been focusing on the inflation part of the dual mandate because it was very clear that inflation was and still is at levels that are too high for their comfort. I do think that the narrative, both for the Fed and also for markets, will now begin to change towards growth or towards employment. In other words, what are the reasons why we're still having this strong economy, and if the lagged effects of monetary policy that they have spoken about for so long, where it takes 12 to 18 months to slow the economy down, well, the lagged effects of Fed hikes will eventually begin to slow things down. We're already seeing that across all indicators, and we should expect that also to happen over the coming quarters.
So then how do you explain jobless claims coming in lower than expected? How do you explain other metrics of wage growth continuing to remain robust?
Yeah, so in that sense, there's still a very strong labor market. Average hourly earnings last Friday went up, and this labor market, obviously in jobless claims, still looking relatively tight, which certainly also get the Fed to say, well, we still need to hike rates more, and still tighter monetary policy is needed.
But at this point, if you see companies, whether it's Delta, whether it's Pepsi, whether it's a number of the others that are seeing profit margins expand with their input prices coming down more than what they can charge consumers, you have people who are employed. At what point does it become a virtuous cycle that offsets any pain of those rate hikes?
Well, and also at this point, as you also talk a lot about, the housing market is beginning to recover. Traffic of prospective buyers is going up. You look, existing home sales is going up. New home sales is going up. Home builder confidence, home buyer confidence. Even the number of offers received per sold property is also going up. Their bidding wars are coming back. And remember, housing makes up 40% of the CPI. So the risk is if we start with the core CPI, which was at 4.8, that's still just way too high for their comfort. So that's why for them, it's still the hawkish communication saying both on the inflation side and on the growth side, on the employment side of the dual mandate, we just got to keep making sure that we don't have an economy that continues to look overheated on a number of different fronts.
I want to look at the larger optimist standpoint that America's fully employed. This was in the zeitgeist off the jobs report 5, 6, 8 days ago. And this is the employment as compared to population ratio of prime age people in America. It is a full recovery mode, literally back on regression, back on trend. That's got to be the most optimistic chart for politicians in America.
Well, and that's why the debate for the Fed is probably, well, do we need to soften the labor market? As you know, different FOMC members are putting different weight on this. Do we need to soften the labor market to get inflation to come down? I mean, let's not forget, inflation today, core CPI, was at 4.8. We are nowhere near the 2% target where they want it to be. And with that backdrop, of course, they will continue to say, we just got to keep going because we still have way too high inflation.
One less understood aspect of Fed policy is not just what happens when you raise rates at the pace they have, but what happens when you hold them for a prolonged period of time, especially as companies have already refinanced and aren't really capturing a lot of the higher yields that are being charged out there by investors. When does that bite? When does that scenario change?
Yeah, no, the very important answer to that is that this is exactly the crystallization of the transmission mechanism of monetary policy. Where is it showing up? And the answer to your question, Lisa, it's showing up in a number of different places. You are beginning to see delinquency rates for auto loans going up. Delinquency rates for credit cards are going up. You're beginning to see default rates for corporates on high yield going up. Loans also see default rates going up. So across the board, both for consumers and for corporates, the conclusion is a default cycle has started. So it is biting. It's just not showing up at the macro level quite yet, but it's very clear that the effects of monetary policy are showing up in the background, and it will eventually begin to slow things down.